Hello everyone, welcome back to yet another controversial video. I'm going to be talking about buying the dip. Before we do that, let's just quickly look at the disclaimer and then we will start with the video. Right. So I want you to read this carefully. I am not a SEBI registered investment advisor or research analyst. Everything that I say ahead is only for the purpose of education and research, right? Don't take any actions based on what I'm talking. Any stocks that I am, talking about in this video are not buying or selling recommendations. Do your own research before you take any action in the equity markets. Do not buy the dip. And I'm not referring to the dip that you get with your nachos, French fries, or chips. I am referring to this dip, which comes quite a few times in many stocks. And investment advisors, pundits, and financial gurus always say that it's a great buying opportunity. Is it really? We'll try and unfold that and try and give you a sense of what I do in situations like these. Let's start off with an example. This is a stock. It's called Yes Bank. Again, not a buying or selling recommendation. Between 2018 and 19, it was, of course, part of Nifty 50, one of the top 50 companies in India, blue chip, great, right? It's a great private sector bank, poised for growth, things like that. Between 2018 and 19, a few events unfold, and the stock started plummeting down. There was a major crisis at the bank, and that's when the stock started moving down, right? All the financial gurus had great faith in the company, and they thought that it will revive. And of course, it did revive, but the stock price is still, trading in that penny stock range now. So every time it started dipping, investment gurus and financial advisors started saying that this is a great buying opportunity, keep buying the dip, right? They did, their rationale turned out to be correct in a certain phase, right? When the stock went to about 130, 140, and then it started moving right back up. It went to 280 and then started correcting back. So this was the area around 280 when the euphoria really kicked in, right? Many investors who did not buy this dip, this big pink candle that I'm seeing, this is a monthly candle, right? There were multiple buying opportunities that came in according to these gurus. If you didn't do this, or if you didn't keep stacking or buying yes back, then you didn't, get to participate in this rally of almost 100%. And if you did not, the FOMO kicked in, and that's when you started entering into yes bank at 280 levels. Now that's when the stock started plummeting down and down and down. And now it is trading in the range of 19. Even today, it's not recovered, and hope is never a strategy, guys, right? So don't hope that Yes Bank will go to these levels again, because it was, trading at these levels once, just a couple years back. Don't sit with that hope. Do your own analysis. Try and understand the business really well before you do this buying on dip strategy. So it destroyed the wealth of many shareholders, of course, the promoter group as well. And yeah, the stock went down almost 99%, 98%. And if you invested 1 lakh rupee, you were left with about 2000 rupees, right? That's the sort of destruction that this stock caused. Next one, another example, India Bulls, great big real estate company and developer in India. They have projects across India, great projects in Bombay, right? So they had a great brand image, everything was great. Again, part of Nifty 50, one of the strongest real estate developers of their time between 2018 and 19. The stock started plummeting down in the middle of 2018. Every dip was treated as a buying opportunity by many investors, but then again, they had they got a big shock on their wallets and pockets once the stock plummeted down all the way to the 15 levels, and now it's trading in the range of 15 and 20. It keeps moving up and down. So again, hope is not a strategy. Don't hope that every time you buy the dip, the stock will move back to the level that it was. Stop, giving into the anchor effect. Stop looking at the historical prices and then making decisions based on that. Of course, we want to look at historical price levels. We want to make assumptions and derivations and use technical analysis. But these are great signals, right? If the tide is turning, it's time to exit. Stop trying to fight the markets. You and I are not smarter than the markets, right? So don't think that you'll sit in your glass office in Lower Parel or New York, like I said in my previous video as well, and try to derive the best valuation of this company, right? That's not your that's not something that you have to do. You have to sit in the markets for a long term, drive the trends, or sit with the trends and follow that. The next one is an experiment. Now, Capital Minds is a big financial services company based out of Bangalore, and they ran a simulation and study, right? And more often than not, we've been told that if you buy stocks near their 52-week lows, you're essentially buying in companies or buying companies at their lowest price, or you're getting a great bang for your buck. Now, if you do that, and especially in the top 100 companies by market cap, and you construct a portfolio of 20 stocks, and you keep doing this time and again, and if you run this for almost 16 years between 2007 and 24, what's the result that you will get, right? And this is something that Capital Mind has already done, and I'm referring to their research. I will also pin their blog post in the comments below for your reference, right? So this is the sort of results you can achieve. The blue line indicates the 52-week low portfolio performance. The gray line on top is Nifty 50. You are far better off than buying or subscribing to this strategy, in an index fund than to subscribe to the strategy, right? So avoid buying stocks at their 52-week lows. There could be a reason beyond your understanding, beyond my understanding, beyond this fund manager's understanding, that is driving the stock below, or that is driving the stock to go, plummet and go down, right? So, and this is, how I try to explain this is anything that you're buying in the market today, not the stock markets, right? Even if you go and buy a phone, any phone that you're buying, if it's of good quality, it's typically or priced at a higher level, right? So if you're buying a phone, if you're paying 1 lakh rupee for it, does not mean that you're buying an expensive phone. The valuation or the value is relative, right? For a content creator, spending 1.5 lakh rupees on a phone could be a great asset for him. For a person like me who is casually recording videos, probably not, right? So valuation is relative. You want to look at the context, but in general, the principle that we see in real life as well is that things which are of great quality are typically priced at a higher level, and that is what stocks hitting their 52-week highs also indicate. That these are stocks where the perceived value is much higher than what their current value is, which is why they're hitting 52-week highs. So let's try and understand if we construct a portfolio of stocks which are hitting their 52-week highs in a similar fashion as 52-week lows, what would be the performance? So the green line indicates that. This is again research from Capital Mind. I'm referring to that. So if you're buying at 52-week highs, constructing that portfolio in a similar fashion like 52-week lows, you're of course beating the 52-week low portfolio, but of course underperforming the Nifty 50 portfolio. So the learning that you have to derive from this is you're better off buying stocks at their highs than their lows. You're better off buying an index fund than picking stocks near their highs or lows. In order to generate excess alpha, there has to be a strategy you have to follow. You cannot simply buy stocks because they're hitting their 52-week highs or lows, right? You need to, you need to do thorough analysis. You need to understand the company in detail, or you need to do your swing trades and positional trades, depending on the type of investor you are, right? So generating alpha in the markets is not as simple as buying the dip. If you want to buy the dip, you can certainly do that you can do that in index funds and mutual funds. And why I say that is because you're essentially subscribing to a basket of stocks, right? You're not investing in individual stocks when you buy index funds or mutual funds. The constituents of that basket keep changing depending on the market conditions, depending on the performance of the stocks within that basket. And there is an investment committee, there is a professional fund manager or an investment manager who takes care of that headache on your behalf, right? So it is their duty to rebalance the portfolio, thereby making it completely tax efficient as well, because you're holding that basket. You will only pay the taxes on that basket when you sell it off. Every time they are buying and selling securities within that basket, rebalancing it, you don't have to pay any taxes because you're not booking the profits at your end, right? So it becomes a tax efficient structure as well. But if you want to follow this buy on dip strategy, and if your investment period is greater than 5 years, certainly go ahead and do that in index funds and mutual funds, because you're subscribing to a basket of stocks. By design, it's corrective, right? They are designed in a way that they will get rid of the laggards, and they'll keep adding winners in the portfolio, right? So that's the design of a momentum driven strategy, or a momentum driven index fund or a mutual fund, in my opinion. If you're buying value mutual funds as well, or if you're buying growth mutual funds as well, The strategy, buy on dip can work for that as well, because you're essentially adding, stocks with great potential in the portfolio and you're removing the laggards, right? So by design, this index fund, ETF, or mutual fund basket will serve great purpose, or will essentially help you confirm to your buy on dip strategy. Don't do it for stocks. Don't try to think that you're smarter than the markets. It's not going to work. I will leave you with this one quote by Mr. William O'Neill, and he said, "Don't try to buy a stock at the bottom or on the way down in price, and don't average down." So if you buy a stock at $40, don't buy more if it goes down to 35 or 30. You and I don't know why that stock is going down to 35 or 30. There could be multiple reasons for it. So stop trying to buy your stocks as they go down. Stop trying to buy them at their bottoms. um, you know, and there are multiple reasons for this. So if you read his book, you will understand that. But I have tried to explain the rationale behind this quote as well through this video. So I hope you follow this. Stop trying to buy the dip in individual stocks. In summary, try to do that in index funds or mutual funds if your time horizon or investment period is greater than 5 years. And that's it for this video, right? I'm going to be coming up with yet another video, or I'm going to be coming up with another video around buy and hold as a strategy, which will be the next one. And stay tuned for that. I will see you guys on Wednesday. Bye bye. Take care.